This video is for educational purposes only and is not professional financial advice. Do your own research before investing. ServiceNow, ticker NOW, a company that has quietly become the operating system for how large enterprises run themselves. And it's growing at 24% a year while doing it. The question isn't whether this business works. The question is whether the market has actually priced in how big this gets. In this video, we're going to answer that. We'll walk through the market opportunity service, Now is attacking, stress test the growth numbers quarter by quarter, dig into the unit economics to see if this business model holds up at scale, and then confront the valuation head-on. Is Now cheap, expensive, or exactly where it should be? By the end, you'll have a real point of view, not just a summary. Let's build the case. Here's the opportunity ServiceNow is sitting in front of. The enterprise workflow automation and software application market is not a small or sleepy corner of tech. Grandview Research puts the market at nearly $30 billion by 2030, compounding at 14.4% annually from 2025 through 2030. Markets and Markets has a slightly more conservative size estimate, $22.1 billion by 2028, but actually a faster growth rate, 15.9% compounded annually from 2023 through 2028. Two independent research firms, two different methodologies, same directional conclusion. This market is expanding fast. Now here's what makes that interesting for ServiceNow specifically. The Now platform doesn't just touch one enterprise workflow. It touches HR, legal, security, customer service, finance, and compliance, all from a single platform. That's not a niche product competing for one slice of the pie. That's a platform play with tentacles across the entire enterprise technology stack. So the real question isn't whether the market is growing. It clearly is. The question is, how much of it can ServiceNow actually capture, and how much has it already taken? Let's talk about something that's easy to undervalue: consistency. Service. Now's revenue growth isn't a hockey stick. It's not a turnaround story. It's something arguably more valuable. It's a metronome. From Q3 2021 through Q2 2026, this company has grown revenue from $1.51 billion to $3.99 billion per quarter. That's not a rounding error in terms of scale. And the year-over-year growth rates have been strikingly stable throughout. 21.1%, 22.7%, 25%, 25.6% in the 2022 and 2023 periods, then 24.2%, 22.2%, 21.3% through 2024, and the most recent quarters coming in at 21.8%, 20.7%, 22.1%, and now 24% in Q2 2026. The acceleration signal here is classified as stable, no meaningful deceleration, and the latest print is actually the strongest in several quarters. Geographically, North America anchors the business at $8.35 billion in annual revenue, but EMEA at $3.4 billion and Asia-Pacific at $1.53 billion represent real and growing diversification. The license and service segment drives the overwhelming majority at $12.88 billion, with technology services contributing an additional $395 million. Is steady growth at 22 to 24% enough to justify a premium valuation? That's the question this whole video is building toward. The growth numbers are real, but growth can be a lie if the business is bleeding money to generate it. So let's look under the hood. Gross margins have been remarkably durable. In 2021, they sat at 77.1%. By 2024, they had expanded to 79.2%. The 2025 figure came in at 77.5%, a modest step back, but still in a range that most software companies would envy. The directional trend is expanding. This is a business where every incremental dollar of revenue costs less to deliver than the ones before it. That's the hallmark of a platform with real pricing power. The Rule of 40 score is 55.3. For context, 40 is the threshold where growth investors start to pay attention. Anything above it says the company is balancing growth and profitability in a healthy way. At 55.3, ServiceNow isn't just passing the test, it's clearing it by a wide margin. And the company is free cash flow positive, No burn, no runway anxiety. Now look at revenue per employee. With trailing 12-month revenue scaling significantly across roughly 29,187 employees, that's a productivity figure worth watching as a signal of operational leverage. Is headcount disciplined relative to the top line? All of that sets up a fair question. The current price-to-sales ratio sits at 12 times versus a sector average of 4.9 times. Is that premium justified by these economics? That's exactly what the next scene addresses. The PS ratio history tells a humbling story. At peak enthusiasm in 2021, the market was paying 21.8 times sales for ServiceNow. By the end of 2022, that compressed all the way down to 10.8 times. A brutal reset. It recovered to 16.1 times in 2023, pushed back to 19.9 times in 2024, and today sits at 12 times. The sector median, shown as a dashed line, is 4.9 times. So yes, Now trades at a significant premium to its peers. But remember the growth and margin data we just walked through. The question isn't whether the premium exists, it's whether it's earned. The valuation meter makes a pointed argument. The PS to growth ratio is 0.50 times. Here's what that means in plain English. You're paying half a turn of sales multiple for every percentage point of annual growth the company is delivering. Below 1 times means the market is underpricing the growth rate relative to the multiple. At 0.50 times, the signal is clear, cheap relative to its growth rate. 60 sell-side analysts cover this stock. 60 of them rate it a buy. 8 say hold. 1 says sell. That's not a divided house. That's near consensus conviction. And the price target range? The lowest individual analyst target is $85. The average of all analyst targets is $140.70. The highest is $236. Against a current price of $105.52, the average target implies roughly 33% upside from here. Every investment case has a flip side. Here's what could go wrong, and what could send this thing higher. First risk, multiple compression. ServiceNow trades at 12 times sales against a sector median of 4.9 times. If interest rates stay elevated or growth sentiment shifts, that premium shrinks fast. And even if the business keeps performing, the stock can stall or fall. Premium multiples require continued market confidence. Second risk, competition and AI disruption. ServiceNow operates in a market attracting enormous capital. Microsoft, Salesforce, and a wave of AI-native workflow startups are all competing for enterprise automation budgets. ServiceNow has the platform depth, but the threat of displacement is real and shouldn't be dismissed. Third risk, growth rate sensitivity. The current 24% growth rate is what justifies the valuation. Any sustained dip toward the mid-teens, even without a business crisis, could trigger a meaningful re-rating downward. Now the catalysts. AI platform expansion is the biggest one. ServiceNow's Now platform is a natural home for enterprise AI agents, and monetizing that represents a potential step change in revenue per customer. Geographic expansion in EMEA and Asia-Pacific offers a second, more linear growth lever. And continued Rule of 40 discipline, if margins expand while growth holds, could attract a new class of quality-focused institutional investors, compressing that valuation discount further. Here's where everything we've covered lands. A platform that touches every layer of the enterprise. Revenue growing at 24% with no signs of structural deceleration. Gross margins in the high 70s. A Rule of 40 score of 55. Free cash flow positive. A PS to growth ratio of 0.50 times, which says the market is paying less than $1 of multiple for every percentage point of growth this company delivers. And 60 out of 69 analysts saying, buy. The bear case is real. At 12 times sales, any sentiment shift or competitive surprise hits hard and fast. Premium multiples don't forgive bad news, but the bull case is louder. ServiceNow is not just capturing its market, it's expanding what that market means, and doing it with disciplined economics that compound over time. The verdict, strong growth buy. This is a business earning its premium, trading at a discount to its own history, and sitting below the average analyst target. Do your own diligence, but the numbers point in one direction.